Hey, today we're going to talk about Mortgage Investment Corporation, MIC. This is a unique product or offering that helps you to invest in mortgages. This is particularly useful for Canadian-based investors who are looking to invest in mortgages to generate income. And should you add this steady income play to your portfolio? So that's what we're going to discuss in this video. So watch till the end to get a full picture of how this works. A quick disclaimer before we go ahead. This is only for entertainment and education purposes, not investment advice. So having said that, let's quickly understand what a mortgage investment corporation is. A MIC is a type of entity or a business organization which holds a portfolio of loans secured by property, which is like mortgages. Okay. So what the MIC does is the MIC pools money from investors and to lend to its, to fund its lending operations, basically. Lending operations which are lending towards the properties. So when that happens, when they lend to these properties, they generate income in the form of interest and other fees. And those are basically profits and revenues for the fund. And part of those profits and revenues, once the operational costs are covered, are distributed back to the investors of the MIC. So someone who is investing in the MIC, for example, if you are investing in the MIG, you're going to get a part of those profits of the fund. And I will explain to you in more detail in the next page about the entire structure and how it works. So the basic structure of a MIC is like this. There are three parties, okay? In the middle, you have the Mortgage Investment Corporation. On the left, you have investors. Let me use a pointer here. On the left, you have investors. On the right, the middle right, you have the portfolio of properties. So let me explain step by step. So what the Mortgage Investment Corporation is trying to do is they are raising money from investors. MIC pools money from investors, and that helps them raise the capital or funds required to invest in real estate and mortgage deals that help them to fund their operations. Okay, so they lend to the properties or portfolio of properties, not just one. So it could be properties in the nature of residential properties or commercial, office, retail, different types of properties. And why they do that is because they try to lend to some borrowers who are not able to get traditional financing from banks. Okay, not necessarily subprime, but these are borrowers who are not able to get the traditional financing from bank for various reasons, and we'll get into that in the next, next page when we go to the next area. But they lend to these borrowers who are not able to get the traditional, mortgage from the regular banks. And what happens is these borrowers are able to, generate income for the fund because they're paying interest, mortgage fees, and so on and so forth. And the fund earns these fees, and they also have a team which they manage. They have their own team of mortgage brokers, underwriters, management, and other staff, support staff, and so on. And and after taking care of all their operations, managing their internal operations, and after taking absorbing all their cost, the remaining profit is distributed to the investors. So the distribution will be in the form of dividends, which are paid usually on a monthly basis, and distributions can vary depending on the amount of profits. So that is how the fund functions. This is actually a mortgage investment. This is not investing in the property as such. Basically, the fund is lending out money to the projects. So that's the key difference you have to understand. So this is distinct or completely different from the REITs, which are real estate investment trusts, which invest directly in the property. In this case, they are only lending to certain borrowers who are investing or working on the real estate projects. Now let's go to the next area. Understand what is the basic structure of the MIC. See, MIC has certain advantages or benefits because of its legal structure. Okay, under the Income Tax Act in Canada, like MICs are required to follow certain rules, and they have to invest at least 50% in residential. 50% or more is accepted, and up to 50% maximum they can go up to 50% in commercial. They cannot do more than 50% in commercial. So this is basically to contain the risks because individual investors like you and me are looking at mortgage investment corporation, and there's a possibility of risk of losing capital. There's a risk of property values coming down, or sometimes interest not being paid, etc. So that's why they are trying to make it more specific to focus on the residential segment, which is more safer. And of course, they have other rules that you know the fund should have at least 20 shareholders, and not no one controlling more than 25% of the MIC. So and MICs are follow-through entities. Basically, all the income that goes to the MIC will be distributed to the investors, and there is no tax on the MIC because ultimately the income goes to the investor, and the investors will uh, get taxed based on their income and based on the type of account they have and so on. So these are the basic features of the MIC. We are not going into all the features, but these are the basic features, and that gives the MIC certain advantages, and that makes this instrument a little different from equities or fixed income and so on. It is a kind of a fixed income in a way, but the returns can vary, and it has certain risks which are tied to the mortgages or real estate segment of the market. Okay, let's understand why the need for mix. Uh, the reason this happened is back in the 70s, like there were a lot of private mortgages and lending happening in the real estate sector, and to regulate that part of the market and to make it more reliable and more, you know, trustworthy, like the government decided to bring in a new set of rules to allow Mortgage Investment Corporation to function smoothly and also to attract capital from retail investors. So for the borrower meaning the people who are borrowing money from the MIC for their projects or properties, it provides a flexible or additional financing option. Uh, like I said in the previous slide, these borrowers cannot go to the traditional banks because they don't check all the boxes that the banks have, and they probably don't meet the bank's big criteria. They cannot go to the big six banks, obviously. They cannot even go to the other, you know, next six banks or 10 banks because they don't check all the boxes. And there are certain cases where getting interim financing or, initial financing for projects which are upcoming is required. And so that is where the MIC comes into place. And this enables interim financing, getting approvals, etc., etc. That's why borrowers like to go with MICs, especially the new and smaller borrowers. And for investors, this gives an option to invest in a diversified pool of mortgages to get income. And the yields in in this fund would be around 7 to 8%. So moderate to high income potential exists for especially income investors, and exposure to an alternative investment class, which is mortgages. And for the MIC, they function like a non-traditional mortgage finance entity between above two parties. And generally speaking, this enables more liquidity or more funds to enable more construction projects. That helps to bring in more supply of homes, supply of commercial real estate, supply of projects, or even shopping centers, offices, different types of real estate to start functioning in the market. Without this kind of facility, it would be very difficult for a lot of projects to take off the ground. And this also provides some kind of a regulated vehicle to invest in private, mortgages. But there is also a lot of public REITs, there's public mix as well. So as we move ahead, we will know the difference. So these are the reasons why there are different parties who are benefiting from the structure. Okay, what is the revenue or business model? Simple, we already know it's the interest income. Interest on mortgage will be priced higher than the borrowing cost. Obviously, there's a spread between the borrowing cost and the lending, price, and that's the main income for the, make. Just like a bank, they have deposits at a lower rate, and then they lend it out at a higher rate. The second major income would be mortgage fee and other fees. The fees paid by the borrower, which includes like mortgage fees, application fees, and so on. In some cases, there could be additional fees as well. So these are the basic revenue that you know MIC generates, but primarily it would be the interest income. The fee income would be slightly a small portion of it. The majority is interest income. So the point to remember is this is going to be a little interest rate sensitive, interest rate dependent sector, just like real estate or even banks. This is going to be closely tied to the real estate, sorry, the mortgage rates and interest rates. Okay, let me give you an example here. I picked some fund. This is not a recommendation, and this is not any kind of advice. This is just a few funds which I've taken as an example. Timber Creek Financial, the ticker symbol is TF, and this is one of the popular publicly listed mix. So there are public and private mix. Like so, we are. This example is about a public one, and ticker is TF, and the name is Timber Creek Financial, and the price is about $6.92. You can see that they are giving a distribution of about 5 cents, 5.75 cents to be precise, and that comes to a yield close to 10%. So 10% yield is very good because you are getting it distributed, like you are getting the, you know, the income from the fund over a year. If you see, you are getting back 10% of your investment from this, and the fund is generating income by lending it to mortgages. And to give you a kind of sense of the portfolio, like what are they investing in? Like, for example, for Timber Creek, they are investing in these 92 different mortgage investments. And if you look at it, they have given a pie chart, giving a breakdown. A majority of it, like you can see that 60.1% is into multi-residential projects or properties. Around 12%, like 11.7, is into retail, and the remaining is a mix of other options like office and unimproved land, etc., etc. So this is the kind of investment that Timber Creek Financial is making, and the average mortgage investment size is about 15 million. So it's a pretty large, size that they are lending to, and this, mind you, that these are not just single family homes or individual borrowers. There is a small single family segment too, which is 2%. But primarily, these are all commercial borrowers. And when they say multi-residential, it could be multi-family apartments. So those kind of formats where there are multiple units, like it's not just one townhome or one single family home. These are like multiplexes or multi-family apartments, townhomes, etc. So you are actually investing in a diversified basket of properties or buildings. So it's not just one borrower, but a more sophisticated borrower who is doing a business that is taking these funds and investing in those projects and paying the interest on these loans. Okay, so they're saying about two-thirds of their business is coming from repeated borrowers. That's just another interesting fact. And by region, like by different provinces, you can see what is the kind of business coming in from the different provinces. Majority, like 43%, is coming from Ontario, and 23.9 from British Columbia, and the rest is from other provinces. Like so, primarily these are in the major provinces of Canada, where there is an active real estate market with a lot of potential, especially the income generating properties. That's where these funds focus on. So these were taken from the results presentation. I will also show you another good example. This is Atrium Investments. The ticker symbol is AI, and this fund is presenting the information in a different format. So yeah, Atrium MIC, and this price is 10.83, and the distribution is 7.75 cents. And if you do the math, like 7.75 cents times 12 and divided by the price, you get a yield of 8.4%. That's the yield you are getting. And this yield can go up and down. Another disclaimer here, these are just based on the historical past data. So bear in mind, and again, this distribution is not constant. Like, so what I've done is I've taken the 12 months distribution, which is variable actually, and then divided that by the price. So that gives around 8% yield, which is still decent compared to fixed income, bonds, etc. This is a good yield, and you can put this in a registered account, non-registered account. So for that, you can consult with your accountant or tax advisor what suits your, investment style, and based on that, you can take that decision. And here I can quickly explain the portfolio. Like in this one, they are saying that they invest about 97% in first mortgages. Just note that here. I'm looking at the first mortgages and then the second mortgages. The second and third mortgages is about 3%. 97% is first mortgages. First mortgage meaning the MIC is lending directly to the borrowers. Whereas in the second mortgages, they are a part of a syndicate, like group of lenders. there is someone who is already given the first mortgage to the borrower. The second second lender is Atrium in this case. So as a second lender, you have a little bit of risk in those cases, but you earn a little higher rate of return or yield. So it's a kind of risky thing, but there is a another lending company which is having the first right on the secured properties. So if something goes wrong or if the borrower is not able to pay back, the first mortgage lender has the first right on the property. The second mortgage lender will have the second right after the first one. So in a way, the second and third mortgages have a secondary hold or secondary lien on the property. So that can be a drawback. But for that risk or drawback, they are getting a higher interest rate. And also some of these mortgages, they would be very short term, like uh, probably 1 year, 2 year, 3 years, because these are not like long mortgages. Like these would be for a specific period of time to achieve a certain purpose. And you can see that there's majority 84% is in residential. And also they've given geographical breakdown. Majority is in GTA, Greater Toronto area, and so on. Like so, this portfolio is pretty much concentrated in the Greater Toronto area, and so that's another factor that you need to keep in mind. So if you're comfortable with that concentration, this MIC is probably something you can consider. But if you're not comfortable, you need a more diversified portfolio. You can look at other mix. So these parameters give you an idea like what kind of mix you can look at and what are the risks, how they are lending, what type of sector they are lending to, what geographies they are lending to, what segments they are lending to. Are they more exposed to the commercial sector? Are they more exposed to single family homes and so on? Yeah. So with that, let me quickly give you a summary of what we discussed before about the public uh, mortgage investment corporation. We saw two examples, Timber Creek and Atrium. There are plenty of other publicly listed REITs. Not plenty, I would say probably a dozen REITs. I'm not sure how many other. Could be a dozen, probably 10, 12. They are listed. These are listed on Toronto Stock Exchange. The advantage is they are highly liquid. It's just like a stock. You can buy it, sell it anytime. It's listed on the market, so it's highly liquid. And the the drawback is it's prone to market volatility. Sometimes even if the market is in a bearish phase, even though the MIC is independent of the stock market, it will still get influenced to some extent with the stock market volatility. It has an influence on the MIC. And if you want to see the financial statements, updates, etc., you can go to the websites of these funds or stock exchange portals and get that information. And most of the funds have the investor relations section. So I would strongly recommend anyone who is considering mix should go and read the investor relations, section of the MIC and probably look at some financial statements, some presentations, or even the management discussion and analysis report. Uh, if someone is interested in a detailed, deep dive into any fund or anything, let me know in the comments below. Probably I will cover that in the next video. And if you're watching this video and you like this content, please feel free to subscribe to the channel and also share any questions or comments that you have, so we can, look forward to your feedback and improve the videos. Okay, so the next part is the private mortgage investment corporation. So these are another option, which I do not recommend. Personally, I don't recommend this. But this is suitable for certain types of people who are, comfortable with investing in these mortgages. So it's not nothing wrong with that, but it has a different kind of risk profile. So in this case, you subscribe for the MIC directly from the uh, fund, or you can go to the authorized distributors because these are not listed. So you have to directly go to the fund to make a purchase or sale, and these are less liquid because they may have something like a lock-in period or certain conditions, and the transactions are done via the mortgage investment corporation fund. So there are certain rules and regulations they may have in terms of entry and exit policies. So you have to be compliant with those policies of the fund, and these are less prone to market volatility. That's a positive. Uh, so compared to the public mix, so that's one reason some people prefer this. And the financial statements, updates, etc., sometimes available on the websites. and sometimes it's a private document. They don't provide it publicly, so they might release only to the active investors. So these are the factors that you need to keep in mind when you're investing in private MIC. Just keep in mind that these are going to be private transactions, and there is a higher level of risk because their performance, financial statements, etc., may not be publicly disclosed. And since they are private, they are not required to disclose it all the time. So they may have certain policies to disclose it on certain intervals, like every 3 months or 6 months. But unlike public mix, they are not required by law to disclose it all the time. So it's a little difficult to do the due diligence on the private mix. So that would be a little bit challenging in terms of trying to find out which fund is good or not. And also trying to get the feedback is a little difficult. So if you're a starter, I would prefer that you consider public mix to start with, and later probably you can look at the private option. Okay, why consider MIC? This is the million-dollar question that people ask. Uh, this is not suitable for everyone. Let me make it clear first that this is not a perfect, you know, product for everyone. This will suit some people for some portfolios, and this will only be a part of the portfolio. This cannot be the core main part of the portfolio. This is only a small part. Okay, this can be a fixed income alternative with better yields. Okay, but just let me give you a caveat or a caution here. Fixed income or bonds. When I say fixed income, I would say government bonds, especially the government bonds which are 100% safe and they are risk free. Theoretically, yeah, and practically they are also risk free because they are backed by the government. So government bonds are pretty safe, and even in a catastrophe or if things go wrong, you're still safe. You're not going to lose your money. But with mix, that is not true, and for that reason, you're also getting better yields. And the risk with mix is probably the interest income generated by the mix can be low, or if some of the deals or projects they finance do not, perform well, or if there is any delay in the payments, delinquency, or bad debts, or any loans that are not paid, any kind of loan losses, um, you know, some of the loans going bad and so on. If that happens, then the fund will have a higher amount of bad debts and losses, and that can erode the value of the fund and also the income of the fund for a long time. So that can be a risk, but they control that risk because they are able to have security or lien on the property. So if the borrower defaults or does not pay on time, they have the ability to go back to them and then uh, try to get the money back or the arrears back as much as they can, or restructure the project or loan, or as a last resort, they can execute the lien and take back the property that is mortgaged, and then to cover their principal and interest and all that, so that once they are paid and their interest and principal is covered, anything left over will go back to the borrower, but the fund will try to recover all of its losses. So in a way, I can say that like there's no guarantees here. Like this is just a concept that I'm explaining. In a way, I can say that the MIC is able to protect its downside, and since it is lending on the security, like on the security which is the property, they're able to recoup most of the value back. And for that, I'll tell you some metrics what to check to assess the safety of the fund. So that way, the MIC is a little bit insulated from the risk, but there is no guarantee that there will not be any risk at all. There is always a chance of things going wrong. And in some cases, even though the MIC has the security to take back the property and all that, sometimes the projects can get into legal issues or problems, and in that case, the case or the issue can drag on for a few months or years. So those kind of risks always exist. I cannot put everything on this page, but I'm just explaining that these practical issues can happen, which are very rare. Like in every deal, this doesn't happen. But probably in a portfolio, like probably one or two deals, some kind of issue can happen like this, and they try to work things out. But in some cases, it cannot be, and it has to be taken. So out of 100, there could be some cases where there may be, 1%, 2%, some kind of loss here and there that can happen. And the MIC also provides a monthly distribution, which is a positive and which is a very good option for income investors. So for people who are looking for capital appreciation and all, this is not a good option. The third point which I'm saying is stable capital or price. Here, I'm not talking about the appreciation or growth. I'm talking about capital remaining safe or stable. Sometimes it can even erode or decline when there is a bad performance or the market cycle is unfavorable. But after those unfavorable moments, the MIC gradually recovers. How much it will recover and what will be the ideal price, it's anybody's guess. Just like you cannot guess the stock price or you cannot guess the bottoms and tops. In this case, you cannot do that same thing. And this is subject to market conditions, interest rate cycles, economic cycles, and real estate market, and so on and so forth. So these are the factors that make mix attractive, and people consider investing in mix. And it's not for everybody. Like it's only for people who are looking for the steady income. And basically, that income will be like a 7%, 10% income uh, on a yearly basis, and that payment will be coming out every month. So that generates some kind of cash flow. So it's not going to be hitting a home run or a big making a big $1 million deal. You will probably if you invest $1,000, like you may be getting a few dollars trickling in every month. And if you increase your investment, you may get some chunk of money every month, and that helps you to maintain your portfolio. But it's not going to be a great income generator unless you invest like tens of thousands of dollars. In that case, you'll get a sizable income. But it's a good option for people who want to have an alternative to fixed income, like bonds. Okay, let's see what features you need to look for in a MIC. Like in the previous one, I was saying that there are risks and you need to evaluate those risks, whether it is with respect to loan or portfolio and so on. Okay, we saw this in one of the examples for Timber Creek and Atrium. Uh, Residential versus commercial. The more you have in the residential side, it's safer. That's one thing to keep in mind. The other is higher percentage of income producing properties is safe. So you don't want to invest in new projects where the project will take another 2 years to get into operation, and then it will start generating income. By that time, it's too late, and it's you put in all the money and waiting for it to come. A lot of money is stuck into that project. So basically, most of the funds invest in income producing properties. There are some funds which invest in new projects and land and so on. So just be aware of that fact. And there should be a lesser percentage of land or under construction. That's the third point, extension of the second point which I mentioned. So you don't want to invest too much in land and under construction. Choose a fund which is not too much aligned to these areas, more aligned to residential and income producing properties. That's the short message. And in the location of market, like if there is a focus on established urban cities, like Atrium is focused on the Greater Toronto market. So if you feel comfortable with that, city centers and markets where there's a lot of economic activity and the chances of failure are pretty less, that's a good option to choose. And you can also choose something which is geographically diverse, like Timber Creek was a little more diverse across different provinces and cities. So diversification across locations or geographies is another point. And type of financing. So this is somewhat similar to the earlier points. Like here, we are saying that we prefer more of first mortgages. So just like I mentioned before, residential is more safer. In this case, I would say the first mortgage type is more safe bet compared to the second and third mortgages. So some of the sophisticated investors, like I used to invest in mix before, uh, when I had a couple of them invested. Like I choose one MIC which is has a higher first mortgage, and I choose another MIC which had a higher second mortgages because I wanted to boost the yield a little bit. Some of the things worked out well for me, but there is always a con. Like the mix which invest in second or third mortgages have a higher degree of risk, and that MIC also had under construction and land projects which were not operating. So that's a risk I took. I'm not recommending anybody to do that. So in current times, I'm not comfortable doing that, and I would not go to that extent because I treat this as a very small part of the portfolio. So I would say go with the first mortgages. Don't try to go too much into the second and third. But if you're a seasoned investor, you know a lot about the market, then you come to a stage where you can take that risk. Yeah, always open. You can always go for that. Uh, what are the other aspects? These are the key metrics to look at. I know this could be a little technical for some people, but it's not that difficult if you understand from the bigger picture. So there are some technical points which I want to throw in here. But for this, I can do a separate video if someone is really interested and you want to see that how these things work. I can explain that in a separate one. And for that, you can put the comments below if you want to see a more detailed deep dive into this. For now, let's make it very simple and short. There are 4 or 5 key points I want to mention. The average term to maturity. How much time to maturity for these mortgages which are lent by the bank? So as long as the average term to maturity is 1 year or less, lower it is, it's always better. But generally they give loans for 1 year, 2 year, or 3 year periods. But there are multiple loans. We are not talking about just single loan. We are not talking about multiple loans. So on an average, when you take an average of all those loans, the maturity is 1 year or less, which means the money is coming back faster and they can reinvest those in other projects or other new mortgages, which is very good actually. If the average term to maturity is like 2 years or 1.5 or 2 years or more, it's going to take a lot of time for the mortgages to mature and complete, and for the fund to get back that money and then reinvest into the new mortgages. So it's basically a cyclical thing. Sometimes these mortgages could run for multiple years, or it could be shorter, depending on what type of projects or what type of borrowers come in. Second would be weighted average loan to value. Loan to value is basically a ratio, the loan amount divided by the property value. So when the loan amount is, let's say, for hypothetical example, let's say the loan amount is, you know, 75% of the property value. Let's say the property value is 100,000. On a 100,000 property, the loan amount is 75,000. Just for simplicity, let's say that's the uh, loan they are giving. So 75,000 divided by the 100,000 is the loan to value ratio. And the loan to value ratio works out to 75%, 75,000 by 100,000. So what the fund is doing is they are trying to lend only 75% LTV, 75% or less. So for a 100K property, they would lend only 75,000 maximum, or even less, probably 70,000 sometimes. So the lower it is, the always better, because they're able to lend less for a higher valued property. So they have that margin or a buffer in case something goes wrong. Even if they sell the property later on, the property value is 100, they have to cover only 75. So they have that 25% margin covered in case something goes wrong. So that's strategy. The LTV is much higher. Let's say 80% or 85%. Just take it as a red flag or a yellow flag. Like it's a kind of a danger, because you want the fund to have a lower LTV to protect you in case something goes wrong. That's a kind of security. And maturity pipeline. The fund has to have at least like 2 years of deals or mortgages. You can see that in the fund documents. If they don't have any property, any lending or anything for the next year or this year, or they don't have the pipeline of deals coming up, the problem is next year probably they don't have anything going on. It can actually reduce your income, or it can reduce the amount of yield that you can get in the future. So most of the funds are actually having a good pipeline. Sometimes the pipeline is low and the economy is down, or probably there are fewer deals. So keep a tab on that. And credit losses is very obvious. As I told you, like bad debts or loan losses has to be minimal. And if it's a higher, you need to examine that and just take a pause. You don't want to invest in funds which have that concern. Or you can just avoid the mix. If you see a lot of mix showing a lot of credit losses and things are not doing well, probably the economy is not doing well, or the real estate sector is not in a good shape. Take a pause and probably don't get into mix at that point of time. And legal issues and cases, read financial statements and notes where they might have said about a particular case or a particular project which has legal issues. In that case, again, just do a more thorough due diligence, or you can consult with your financial advisors or people who know about that issue. Uh, so these are the things to look for. And benefits of investing in public mix. As I said, it is more safer than investing in private mortgages or even the syndicate mortgages, and it provides a greater flexibility or diversity, because you're not lending to one person. In private lending, you're probably lending to one borrower or you're lending to few borrowers, and it's a concentrated risk. Like if one of them defaults or something goes wrong, you don't have an option. But in the public mix, you are investing in a diversified pool, so you have a more lesser risk and more diversified portfolio to handle, and not much of volatility as well. And it is highly liquid. You can always sell it in the market if you want to, liquidate your funds, you want to exit for whatever reason, you need the money, or you want to book profits, or you want to avoid any losses. And public mix are fully regulated, and access to disclosures is always available. And that's the very important thing, because we don't have access to disclosures, you are just guessing and you're speculating. Like, don't do that. And these usually have strong internal controls and compliance processes, especially the public mix, because they have to report every quarter and they have to update their financials and news and so on. So that's the benefit of investing in public mix. So anyone who is starting off, always start with public mix. Limitations: any product, any instrument has its limitations, and the mix are not different. They can be influenced by stock markets, and sometimes the ease of exit can be unfavorable. When the price falls, the price is too low, now you cannot sell. If you want to exit, but problem is you're not getting the right price. You invested at $10, now it is trading for $7. Like, that can happen, and market price may not reflect the true value of assets. Sometimes the MIC may have a lot of assets which is very valuable, and their true net asset value is higher, but the market price could be low because of some other market sentiments or interest rate trends and so on. And these provide little or low capital appreciation. This is not for capital appreciation, to be honest. And but it helps you maintain capital stability, not appreciation. And dividend distribution is variable. Many people look at the distribution trend and think that, oh, okay, I'm going to get this dividend every month. It's true to some extent, but you may not get the exact same, and there's no guarantees. Just keep that in mind. It depends on the performance of the fund. Sometimes it can go up, it can go down. And investor base is generally retail investors like you and me, and a lot of retail investors who have interest in getting that regular income and flow. And probably some institutions invest in mix. I'm not too sure about that. You can let me know if you know the answer, like whether institutions or larger players also invest in mix. And the Mortgage Investment Corporation need to continue funding new deals and opportunities to maintain presence. This is one factor which is common to mix as well as REITs. These businesses have to find new deals, have to maintain their business. They cannot close their doors one day and then say that, oh, okay, from tomorrow we're not going to run this fund. They cannot do that. Some private mix have a certain specific time they can run the fund for X number of years, and once the loans mature, they can close. But public MIGs are not like that. They have to keep functioning. So they have to keep hunting for new deals. They have to keep hunting for new opportunities. So some of the public MIGs have to be scrutinized, and you have to find out like whether they have the personnel to do the deals, whether they have other sister companies or affiliate companies to help them get the deals. Do they have the team of mortgage brokers, or do they have a team of other marketing and real estate experts who can source deals for the company? Or do they have other companies or other construction and real estate, um, you know, marketing companies who can get them those deals? So that is something you need to go case by case and look at the, financial reports and even the management discussion reports to understand what is happening. Okay, so and other factors to consider when adding mix. Already discussed some of the factors in the previous page, but one factor to keep in mind that yield is going to be like 7 to 10%. Similar to fixed income option, you're getting a higher yield. Uh, this is good for most people who want to do a conservative play, but this is not safe like a government bond. But this is slightly on better than slightly better, higher yielding, but slightly riskier than government bond, but higher yielding. And there's little or no capital appreciation, and mix should be only a small portion of the portfolio, like 5% of starters. And these are not going to be multi-baggers or home runs. That's not going to happen. And these are subject to interest rate cycles or even economic or real estate market cycles. Okay, requires tracking fund performance or results. That's another risk. Unlike index ETFs where you invest in one basket and just set it and forget it. This is not going to be 100% set it and forget it option, but you need to still track the fund performance. But compared to stocks and some compared to those kind of options, this is easier to track. But you still need to track the fund's performance. How it is performing, what's good, what's not good, and whether I want to increase my exposure or not to increase my exposure. These kind of questions will always be there, and it requires some amount of effort on tracking in performance. And there is no MIC ETF. We have a real estate investment trust ETF or real estate investment trust index ETF, where you invest in a basket of REITs, different REITs packaged into one basket. Currently, we don't have a mortgage investment corporation basket. I wish we had one like that. Probably some funds may be, launching this kind of a new idea. Recently, I heard about real estate covered call ETF, like that was RMAX. I'm also going to do a video on that next. Uh, that's a pretty interesting concept. They write covered calls on real estate stocks and real estate companies, and that generates regular income and also provides a bit of capital appreciation. It's like getting a mix of both in one product, and they are giving you higher yields, like probably 8-9% dividend yields, uh, much higher than REITs. REITs probably provide you like 4 or 5% yield. Uh, you know, so that's a new concept that I'm also researching on. Probably there will be a video on that next. But in MIC, we don't have that right now. In a basket fund doesn't exist as of now. So something may come in the future. Let's see. So what next? So if you'd like me to do a deep dive on a specific mortgage investment corporation, let me know, as I said before. And if there is any new REIT or MIC or real estate fund that you'd like me to cover, please share your comments that I can, or you can put in your, notes or comments in the description below. I can cover that in future videos, or I can do more research on that. And if you like this channel, please continue to follow the channel and also share your questions, comments, and feedback. Thank you and have a great day.